I'm Jesse Mackey, CIO of 4Thought Financial Group, and this is 4Thought's Quant Market Perspective as of June 14th, 2022. Yesterday, the S&P 500 Price Return Index reached a new maximum intraday drawdown of 22.5% from its January 4th peak price. After initial confirmation of the new bear market on May 20th, based on the technical intraday definition of a 20% plus decline, the index had rebounded significantly, but experienced a rapid decline during the last week to bring it back to its current level. The initial indication of a bear market on May 20th has very significant implications for portfolio management strategy. The history of the S&P 500 index since 1950 reveals that once the bear markets have been identified, in which a 20% plus decline from a record peak has occurred, they have continued for an average of an additional 4.61 months and have experienced an average additional cumulative loss of 16.56% until the trough is reached. However, 6 out of 13 instances of a bear market turned around within 1 month after it was indicated, some as early as the same day, while all others lasted longer, up to a maximum of 1.63 years. For long-term investors that can afford to wait until a recovering upturn in the market cycle, such data calls for aggressive deployment of cash and other conservative instruments into stocks, and intermediate to long-term bonds in this case, both immediately and in the months following confirmation of a new bear market. One example of how long-term investors can take action now is to immediately deploy 62.5% of any idle cash not needed for short-term liquidity or expected upcoming spending into their diversified managed account portfolio, with the remaining 37.5% split into 3 equal installments of 12.5% each to be deployed each month for the next 3 months. This should be discussed with your advisor to confirm appropriateness for your situation before taking action, of course. Based on analysis of the complete historical market type data set using our multi-method adaptive algorithmic process, we're now allowing overweight allocations to strategic asset allocation and underweights to liability-driven investing, opportunistic investing, and selective concentrated investing. From a probabilistic analysis perspective, valuations tell a story that's positive for most stock types, but even more favorable for some bond types. On this basis, most stock types are now moderately undervalued. Bonds range from moderately undervalued, in the case of Treasury inflation-protected securities, to deeply undervalued, in the case of investment-grade corporate bonds. Investment-grade corporate bonds now reflect the most attractive pricing relative to the alternatives, while emerging market stocks are the least attractive. U.S. large-cap stocks are the worst-performing publicly traded broad asset types so far this year, while U.S. short-term bonds have been the best, despite their own negative returns. Against this backdrop, the outlook for stocks is now significantly positive in the intermediate term based on the overall aggregate of our historical market type data analysis and quantitative probabilistic analysis. I hope this was helpful. If you have questions or you'd like to discuss what this means for your particular situation, please contact 4Thought at 516-300-1617 or at info@4tfg.com. And don't forget to subscribe to our blog feed and our YouTube channel. Thanks for watching, and see you next week.